I'm George Soros. I've been investing for over 70 years, and I'm worth about $7 billion. Young people ask me this question all the time. George, if you had to start over today with nothing, no money, no connections, no reputation, how would you build wealth from scratch? And I always give them the same answer. I do it faster now than I did 60 years ago. Not because I'm smarter, though I've learned a few things, but because the opportunities available in 2026 are extraordinary, if you know where to look. Most people see the current economic chaos as a problem. Record inflation, geopolitical tensions, market volatility, currency instability. They're scared, they're paralyzed, they're waiting for things to calm down before they start investing. But I see something completely different. I see the greatest wealth-building environment of my lifetime. When I broke the Bank of England in 1992, I made $1 billion in a single day because I understood that crisis creates opportunity. Today's crises are creating opportunities that dwarf anything I've seen in 6 decades of investing. If I had to start over in 2026 with absolutely nothing, no capital, no track record, just knowledge and determination, I could build $1 million faster than most people think possible. Not through luck or gambling, but through systematic application of the principles that have guided every successful trade of my career. Here's what most people don't understand about wealth building. You don't need a lot of money to start, but you do need to understand how money flows during periods of uncertainty. You need to position yourself where capital is moving, not where it's been. You need to think like the institutions and governments that control trillions of dollars, because they're about to make moves that will create massive opportunities for small investors who see them coming. The roadmap I'm about to share isn't theory. It's not motivational speaking. It's the exact strategy I would use if I was starting from zero today, based on the specific conditions and opportunities that exist right now in 2026. Because here's the truth that financial advisors don't want you to know. The traditional advice about slow, steady investing through index funds might have worked in the past, but it won't work in the environment we're entering. The rules have changed, the opportunities have changed, and if you're still following the old playbook, you're going to get left behind. This isn't about get-rich-quick schemes or risky speculation. This is about recognizing that we're living through a historic wealth transfer from those who don't understand what's happening to those who do. And I'm going to show you exactly how to position yourself on the right side of that transfer. Step 1. Master the currency collapse. That's already started. If I were starting from zero in 2026, the first thing I'd do is position myself for the currency devaluation that's already underway. Most people don't realize it yet, but we're witnessing the early stages of a dollar debasement that will accelerate dramatically over the next few years. The mathematics are simple and unavoidable. The US government has accumulated over $35 trillion in debt that can never be repaid through normal economic growth. The only way out is through inflation minus deliberate currency debasement that reduces the real value of that debt over time. The Federal Reserve knows this. Treasury officials know this. They can't say it publicly because it would trigger immediate panic, but their actions speak louder than their words. Money supply expansion, yield curve control, and indirect debt monetization are all signs that currency debasement is the official policy, even if they won't admit it. Starting from zero, I'd focus on 3 specific currency plays that ordinary investors can access. First, I'd put 40% of any initial capital into physical assets that benefit from dollar weakness, not gold. That's what everyone expects. I'd focus on industrial metals like copper and silver that are essential for the green energy transition, but are priced in dollars. When the dollar weakens, these commodities become cheaper for foreign buyers, driving up demand and prices. You can access these markets through ETFs like PDBC for broad commodity exposure, or specific funds like CPER for copper and SLV for silver. Start with small positions and build them gradually as currency pressure becomes more obvious. Second, I'd establish positions in foreign currencies that will strengthen against the dollar. The Swiss franc and Singapore dollar are obvious choices because these countries have lower debt levels and more disciplined monetary policy. But the real opportunity is in emerging market currencies like the Indian rupee and Indonesian rupiah. These currencies are already undervalued. Their economies are growing faster than the US, and they're less dependent on dollar financing than they were during previous crisis periods. ETFs like FXI for China, INDA for India, and ETO for Indonesia give you exposure without needing to trade Forex directly. Third, I'd position for the collapse of the European monetary system, which is even more fragile than the dollar system. The euro was designed with fatal flaws that make crisis inevitable when external pressure increases. Italy, Spain, and other peripheral countries have debt levels that can only be sustained if interest rates remain artificially low forever. When the next crisis hits and rising interest rates make it inevitable, the choice will be between letting weak countries default or printing euros to bail them out. Either outcome will devastate the euro, creating enormous opportunities for those positioned correctly. The timeline for currency collapse is accelerating because central banks have exhausted their conventional tools and must now choose between economic recession and currency debasement. They'll choose debasement every time, making currency plays the highest probability trade of the decade. With just $10,000 to start, you could build currency positions that will multiply several times over as these trends play out over the next 3 or 5 years. This isn't speculation, it's positioning for mathematical certainties that central banks are trying to hide. Step 2, ride the artificial intelligence revolution wave. The second pillar of my wealth building strategy would be capturing the artificial intelligence transformation that's reshaping every industry, but not in the obvious way that most investors are approaching it. Everyone knows about Nvidia, Microsoft, and Google. These companies are already priced for perfection and will likely underperform going forward because expectations are too high. The real money in AI will be made in the companies that AI transforms rather than the companies that create AI. If I were starting from zero, I'd focus on 3 specific AI transformation plays. First, healthcare companies that are using AI to reduce costs and improve outcomes dramatically. Companies like Veriseed, which uses AI for cancer diagnosis, or 10x Genomics, which applies AI to genetic sequencing. These companies are trading at reasonable valuations despite having revolutionary technologies that will dominate their markets. The healthcare AI revolution is just beginning. Because regulatory approval takes years, meaning most investors don't understand how transformative these technologies will be. By the time the benefits become obvious, these stocks will have multiplied several times. Second, industrial automation companies that are benefiting from the AI-driven reshoring of manufacturing. Companies like Rockwell Automation and Cognex provide the robotic systems that make domestic manufacturing competitive with overseas production again. The trade war with China and supply chain vulnerabilities exposed during COVID are forcing companies to bring production back to the US and Europe. But this only makes economic sense if they can automate enough to offset higher labor costs. AI makes this automation possible for the first time. Third, energy companies that are using AI to optimize production and reduce costs. The energy transition isn't just about renewable energy, it's about using AI to make all energy production more efficient. Companies like SLB and Halliburton are applying AI to oil and gas exploration, dramatically reducing costs and improving discovery rates. The key insight is that AI will make traditional energy production more competitive, not less competitive, because it reduces the main cost disadvantages compared to renewables. This contradicts the popular narrative, but reflects the economic reality of how AI applications actually work. Starting with $5,000, you could build a diversified AI transformation portfolio, focusing on these overlooked applications, rather than the obvious AI companies that everyone else is buying. The returns potential is enormous, because these companies are solving real problems with proven technologies, not just riding the AI hype cycle. The timeline for AI transformation is much faster than most people realize, because the technology has reached the point where it provides immediate economic benefits rather than just theoretical possibilities. Companies that implement AI successfully will dominate their competitors within 3 to 5 years. Step 3. Position for the coming debt crisis. The third element of my wealth building strategy would be positioning for the sovereign debt crisis that's approaching across multiple countries simultaneously. Government debt levels have reached unsustainable levels in most developed countries, but investors haven't recognized the implications yet. This creates extraordinary opportunities for those who understand debt mathematics and can position before the crisis becomes obvious to everyone else. The US debt to GDP ratio is approaching 130%, levels that historically have led to either default or devaluation in every country that has reached them. European debt levels are even worse when you include private debt and unfunded pension liabilities. Japan's debt ratio exceeds 260%, a level that defies all historical precedent. These debts can only be serviced if interest rates remain artificially low forever, but inflation is forcing central banks to raise rates despite the debt burden. This creates an impossible situation that must resolve through either default or devaluation. If I were starting from zero, I'd position for this crisis through three specific strategies. First, I'd short government bonds in the countries with the worst debt dynamics, long-term US Treasury bonds, German bonds and Japanese government bonds are all priced for continued ultra-low interest rates that are mathematically impossible to maintain. You can short these bonds through inverse ETFs like TBT for US Treasuries, JGBS for Japanese bonds, and EWG for German bonds. These positions will multiply in value when interest rates rise or credit concerns emerge. Second, I'd buy credit default swaps or high-yield bonds in countries with better fiscal positions. Countries like Norway, Singapore, and Switzerland have low debt levels and strong economies that will benefit when investors flee from over-leveraged countries. Third, I'd position for the corporate debt crisis that will follow the sovereign debt crisis. Corporate debt levels are at historic highs, and most companies can't survive in a high interest rate environment. When the defaults begin, high-quality companies with strong balance sheets will buy their competitors' assets at distressed prices. Companies like Berkshire Hathaway, Microsoft, and Apple have massive cash reserves and minimal debt, positioning them to acquire distressed assets when the credit crisis hits. These companies will emerge stronger while over-leveraged competitors disappear. The debt crisis timeline is accelerating because central banks can't keep rates low without triggering runaway inflation, but they can't raise rates without triggering defaults. This impossible position means the crisis will arrive sooner than most people expect, probably within the next 2-3 years. Starting with $5,000, you could build positions that will generate enormous returns when the debt crisis becomes undeniable. The key is positioning before the crisis rather than reacting after it becomes obvious. Step 4, exploit real estate mispricing. The fourth pillar would be exploiting the massive mispricings in global real estate markets created by years of artificial low interest rates. Different regions are experiencing completely different dynamics, creating arbitrage opportunities for those who understand the underlying drivers. If I were starting from zero, I wouldn't buy real estate directly because that requires too much capital and leverage. Instead, I'd use REITs and real estate ETFs to gain exposure to the specific types of properties that will benefit from current trends. The key insight is that real estate markets are segmented, and different segments will perform dramatically differently over the next few years. Residential real estate in expensive coastal markets is overvalued and will decline as interest rates rise. But industrial real estate, data centers, and certain international markets are undervalued relative to their future cash flows. First, I'd focus on data center REITs like Digital Realty Trust and Equinix. The AI revolution requires massive increases in computing power, which requires massive increases in data center capacity. These companies own the physical infrastructure that makes AI possible, and demand is growing faster than supply. Data center REITs are trading at reasonable valuations despite having the strongest growth prospects in the real estate sector. As AI adoption accelerates, these properties will become more valuable because they're essential infrastructure that can't be replicated quickly. Second, I'd invest in industrial REIT focused on logistics and manufacturing facilities near major population centers. The reshoring trend and supply chain reorganization requires new domestic manufacturing capacity, creating enormous demand for industrial real estate. Companies like Prologis and EXR own the types of properties that benefit from these trends. They're generating strong cash flows and increasing rents, but their stock prices don't reflect the full value of their strategic locations. Third, I'd gain exposure to international real estate markets that are undervalued relative to US markets. Asian REITs in Singapore, Japan, and Australia offer higher yields and better growth prospects than US REITs, but they trade at significant discounts because US investors don't understand these markets. ETFs like VNQI provide international REIT exposure without requiring individual stock selection. The yield advantages and currency appreciation potential make these attractive alternatives to overvalued US real estate. Starting with $5,000 to $10,000, you could build a diversified real estate portfolio focused on the sectors that will benefit from technological and economic transformation rather than the sectors that everyone else is buying. Step 5. Create asymmetric option strategies. The fifth and final element would be using option strategies to create asymmetric risk-reward opportunities that can multiply small amounts of capital rapidly when major market moves occur. Most people think options are gambling, but when used correctly, they're tools for creating positions where your maximum loss is limited, but your maximum gain is enormous. This is exactly what you need when starting from zero, because you can't afford to lose much, but you need the potential for large gains. If I were starting from zero, I'd focus on 3 specific option strategies. First, I'd buy deep out-of-the-money puts on the most overvalued assets as insurance against crisis events. Put options on long-term treasury bonds, expensive growth stocks, and commercial real estate ETFs provide massive leverage if these assets collapse. The key is buying options with enough time to expiration that you're not fighting time decay, but far enough out of the money that they're cheap enough to buy multiple positions. 6-month puts that are 20–30% out of the money provide good risk-reward ratios. Second, I'd sell covered calls against positions I already own to generate additional income while waiting for major trends to play out. If you own commodity ETFs or international stocks, selling covered calls against them generates extra income while maintaining most of your upside potential. Third, I'd use bull call spreads on assets that I expect to appreciate but want to limit my risk exposure. Instead of buying expensive call options, you buy lower strike calls and sell higher strike calls, reducing your cost while maintaining substantial upside potential. The key to successful options trading is thinking in probabilities rather than predictions. You don't need to be right about timing or magnitude. You just need to be right about direction and have positions that benefit more from being right than they suffer from being wrong. Starting with just $1,000, you could create option positions that provide 10–20 times leverage on the major trends we've discussed. The key is never risking more than you can afford to lose on any single position, but creating enough positions that some of them will generate enormous returns when major market moves occur. The complete $1 million roadmap. Bringing all these strategies together, here's exactly how I would build $1 million starting from zero in 2026. Month 16. Start with any amount you can save, minus even $500. Focus on currency positions and AI transformation stocks. Build these positions gradually while learning about the companies and trends.
Month 7–12. Add debt crisis positions and real estate exposure as your capital grows. Use dollar cost averaging to build positions over time rather than trying to time entries perfectly.
Year 2, begin adding option strategies as your portfolio reaches $10,000. Use options to amplify exposure to your highest conviction positions while limiting downside risk. Year 3–5, as positions mature and market dislocations occur, compound your gains by reinvesting in the same strategies that generated initial success. The key is patience and persistence, rather than seeking immediate gratification. The timeline assumes starting with minimal capital and achieving average annual returns of 40–60%, which is realistic given the opportunities available in current market conditions. This isn't fantasy, it's what happens when you position yourself correctly for major economic and technological transitions. The most important principle is to start immediately with whatever amount you have, rather than waiting for perfect conditions or larger amounts of capital. The opportunities I've described are available now, but they won't be available forever. Market dislocations create wealth-building opportunities that close quickly once they become obvious to everyone else. Remember, building wealth isn't about being smarter than everyone else. It's about understanding how capital flows during periods of change and positioning yourself where that capital is going, rather than where it's been. The strategies I've outlined take advantage of changes that are already underway, but not yet fully recognized by mainstream investors. The choice is yours. You can follow conventional wisdom and accept conventional returns, or you can think independently and take advantage of the extraordinary opportunities that crisis and change always create for those prepared to see them.